Hi, this is the RITE Report of February 11th, 2021, and I'm your host, Chris Angle. I'm the author of 4 books on philosophy, and one of which is the Philosophical Equations of Economics. Along with me is my colleague and co-host, Rick Samuelson. Rick graduated from Yale, has MBAs from Wharton and Tufts. He's an independent venture capitalist. Good to see you, Rick.
And you.
Approximately once a month, we put out a report on the state of the stock market and the economy. And the program uses the RITE Report, which can be seen at www.stock-market-direction.net. And it's the natural outcome of the book that I just mentioned. So let's get to it. Let's bring up the RITE Report and see what's happening. So first we're going to go over the macroeconomic snippets, little pieces of news that have come out over January and through the major sources of information such as the U.S. Census. Here we've got total non-farm payroll employment declined by 140,000. So this first section is our negative economic snippets. Then we have U.S. retail and food service sales was a decrease of 0.7%. From the Bureau of Economic Analysis, consumer spending decreased 0.2%. Productivity decreased 4.8%. And in manufacturing, unit labor costs decreased 2.4%. Total of 5 negative snippets. On the positive side, I think there's quite a bit more. The November 2020 sales of merchant wholesalers was up 0.2%. From the Kansas City Federal Reserve Bank, reported that district drilling and business activity increased in the fourth quarter. From the Bureau of Labor Standards, real average hourly earnings increased 0.4%, and average hourly earnings increased 0.8%. Real average weekly earnings increased 0.1% over the month in December. Privately owned housing starts in December is 5.8%. above the November revised estimate. From the Wall Street Journal, U.S. home sales in 2020 surged to their highest level in 14 years. From the Chicago Fed National Activity Index, increased 0.52 in December. World trade volume increased 2.1%. With this, the world trade volume is slightly higher than at the end of 2019, pre-COVID. So this is a pretty important statistic. New orders for manufactured durable goods in December increased 0.4 billion, or 0.2%. From the Federal Reserve Bank of Kansas City, released their January manufacturing survey and revealed that the 10th district manufacturing activity increased. Sales at a new single-family houses in December is up 1.6%. December end of month inventories were 650 billion, up 0.1%. Personal income increased 0.6%. Total construction activity was up 1%. The homeownership rate of 65.8% was 0.7 percentage higher. And new orders for manufactured goods in December increased 1.1%. In the fourth quarter, The unit labor costs increased 6.8%. In manufacturing, productivity increased 3%. Unemployment fell by 0.4 percentage to 6.3 in January, bringing our positive snippets up to 19. So we got 21% of the news was negative and 79% was positive. Now moving on to our economic analysis and indicator summary. High yield bonds were up over the last month. Select dividend iShares was up. The ISM Purchasing Managers Index, although it was up and it points to the economy expanding, it did fall 2 percentage points from the last reading that we had. So even though the economy is expanding, we're still going to give this a negative rating. The IHS Purchasing Managers Index is 59.2, expanding, positive. Construction spending was up 1%, positive. Unemployment rate decreased to 6.3%, that's positive. Civilian labor force participation rate decreased to 61.4, that's a negative. Employment population ratio increased to 57.5, positive, and the employment trends index put out by the conference board went negative. So we got 2 negatives, 2 positives. We're going to give this a neutral. Non-farm business sector. Productivity decreased 4.8%. Output increased 5.3%. In manufacturing, productivity increased 3%. Output increased 11.2%. Positive. U.S. manufacturing corporations seasonally adjusted after-tax profits. Third quarter was up $100 billion, 0.8%. And so we're going to make that a positive. Advanced estimates of U.S. retail food service sales in December decreased 0.7%. A combined value of distributive trade sales and manufacturers' shipments for November down 0.1%. And the industrial production index put out by the St. Louis Federal Reserve upticked, so definitely a positive. Velocity of money, however, downticked. New residential construction, privately owned housing units was 4.5% up. The Conference Board leading economic indicators increased over this last month, so positive, and also the coincident economic indicators put out by the Conference Board also increased. New residential sales is up 1.6%. New orders for manufactured durable goods in December up 0.2%. National Association of Realtors reported a 0.7% increase in existing home sales. And from the Bureau of Economic Analysis, real GDP was up 4% in the fourth quarter. Personal consumption expenditures were down 0.2%. Personal income up 0.6%. Restaurant Performance Index at 98.6, which indicates a contraction, but it's up 1.1% from over the last month, and so we're going to put that as a positive. From corporate profits, increased almost $500 billion in the third quarter, and it's a positive, definitely. From new orders for manufactured goods in December, increased 1.1%, and world trade volume, as we noted above, increased 2.1% to pre-COVID values, which is great news. And above, as reported, the Chicago Fed National Activity Index was up 0.52. Housing prices rose up 1%, and housing prices rose 11%. The previously reported 1.5% change for October remained unchanged. Okay, so we've got positive 22 indicators, 5 negative indicators, and 1 neutral. So now we're going to kind of put this all together with our general comments. The domestic political risk is down to a -5 because the Democrats' campaign rhetoric indicated a preference for future tax increases. Near-term plans seem to be centered on social justice and fossil fuels, so they haven't got around to that for increasing future tax increases, but they probably will. So, until then, we'll just put this as a -5. Tax risk, so the corporate taxes remain in place. The Democrats haven't gotten to that. Changing this does not yet seem to be in their focus, and further, it appears that they would not have the votes in the Senate to change this anyway. That can change. So, but for right now, we'll give it a +8 because it looks like the taxes situation will stay in place. Regulations will likely increase, so we're going to put that as 0. Government and corporations are spending money on research because the huge deficit spending is coming online, and there'll be some of that spilling over into research into the universities. Technical analysis of the market is pretty good. Market continues to go up. General business and economic snippets, as we said above, are at 79%. That's good. That's high. So +5. Although the economic indicators from last month slipped from 23 positive to 22 positive. But that's pretty good. So total of 29. And so our RITE Report Strategy Index increases slightly from 69.7% to 70.7%. And so we're up slightly, and so our summary here at the RITE Report is: in spite of the market suffering a devastating downturn from the epidemic, it is now recovering due to the positive business and economic news, along with positive developments in medicines, treatments, and vaccines for COVID-19. Additionally, the RITE Report Strategy Index recovered slightly this month. It seems that the Democrats, for now, are only attempting to bring social justice to the forefront of their policy changes. It appears that they will not have the necessary votes in the Senate to change the tax laws, which will allow the stock market to continue to advance. Thus, the RITE Report recommends to go back to long positions. So let's find out what Rick has to say about the economy and the stock market. Rick, what's your opinion?
Well, I guess the overrunning question is, to what degree is the good news from the point of view of recovery already priced in? On a number of measures, valuations are stretched. Anyone who invested last March or April is probably up 3 times. And I think we've entered a phase where going forward, you're going to see more of a trading market. You're seeing that already with the recent, Robin Hood related pumping of shares and retail investors betting against hedge funds. So we've entered the territory where taxi cab drivers are providing investment advice. So is it frothy? Obviously, anyone can see that. So I guess it will pay going forward to take careful note of what are the possible negatives that could derail all of this. The Democrats appear ready to force through on the basis of reconciliation this full $1.9 trillion package, including ultimately a wage increase nationally to $15 an hour. Will that end up in the final package? Remains to be seen. Probably not. But this is a pretty ideologically driven party now, and that is one of the sacred cows for the likes of Bernie Sanders and others. So it still could. The Congressional Budget Office has estimated that if that were to prevail, 1.4 million jobs would be lost, and that's that's Biden's own government making these forecasts. So that's a pretty big negative hanging out there. I don't think we're done with the layoff. Many companies have received loans to keep people employed. You could argue that this 1.9 trillion will be the first of a number of debt-driven rescue measures that the Democrats will try to force through over the next 4 years, so that we'll be almost in a constant crisis mentality whereby an ever larger number of people are paid not to work, more companies are being rescued. All of that sounds vaguely like Japan in the 20, 30 years ago. So there's zombies at the margin could be kept alive longer. Obviously, debt ratios at the government level, at the corporate level, at the personal level are exploding, and that always leads to disaster over time. Will that happen this year? Probably not. Will it happen next year? Hard to say. Will it ultimately happen? Of course, always does. You can't keep growing your debt ratios indefinitely. Trees don't grow to the sky. So my view is trade this market prudently. There'll be many buying opportunities going forward as the market gyrates on any bad news. Will China invade Taiwan? If I had Biden for president of the United States, I'd be very tempted. What would that do to the stock market? Probably hit it pretty hard. So there are a number of outliers there in terms of world affairs, in terms of ever rising debt ratios, in terms of latent unemployment problems. I don't believe the unemployment number of 6.7%. Actually, the chairman of the Fed commented the other day that he thinks actual unemployment is like 10%. So again, you have sources within the government itself contesting the official figures, and that seems to be much more accurate. I mean, I know of waitresses working at local restaurants who are essentially working for free because they want to keep the business going. How long is that going to last? Anyone who says the restaurant business is truly recovering is, I think, hallucinating. Just go talk to the owners, and you'll find out they are on fumes. They are operating on fumes, and so I think you're going to have more bad news there. If not in terms of firing people, in terms terms of businesses being forced to automate, whether it's because of rising minimum wage levels or because that kind of efficiency is necessary to stay alive in a volatile business environment. It was noteworthy that the other day, a robotics firm was acquired by one of the food providers, food delivery companies, for obvious reasons. They want to automate the production of food. Well, what's that going to do to, food workers? So I think you're going to see, and indeed, we haven't necessarily gotten out of the COVID crisis yet. So let's say a variant arises in the fall, and that's already being predicted. You may see more lockdowns. There's no sense that international travel will return to anything like normal levels before, let's say, the end of 2022. So there are all kinds of distortions there and potential surprises that I think could present the kind of negative information that would allow for very profitable trading in this kind of market.
I got a question for you, Rick. At the current level of the deficit spending, last year we had two bills, and the most recent was in December, another one on its way. And let's say, again, later on in the year, just like last year, there's another one. How long can the United States maintain this deficit spending before dire consequences surface?
Well, you would say that at 100% debt equity, in terms of federal debt to the GDP, you're already at a very high level. We're already at levels exceeding that of World War II. But there you have Japan, you have Italy. They're at nearly double our levels. So the answer is it can go on for quite a long time, and more importantly, everyone's doing it. Right, the whole world's doing it. So you can't really point to the United States as being the lone bad actor, and that's why even though the forecast call for a depreciating dollar, depreciating against what? The euro? I doubt it. If we have problems, Europe has twice as many. Their unemployment is twice as bad. Their lack of technological proficiency is horrendous. Right? They have very few industrial leaders. They're way behind in most technologies. It's all for Europe. Outside of Germany, it's hard to find good news. Will the Chinese yuan, appreciate against the dollar? Yeah, of course.
Okay, let me rephrase the question. When would worldwide inflation surface?
Well, it could be any day. The question is, when will the one source of inflation would be to raise the minimum wage to $15 an hour, right?
Yes.
Because employee cost is the largest single item for any business. So that's a built-in source of inflation right there, if and when that is implemented. So you can see sources of inflation like that, structural inflation, already on the horizon. And that's another reason I think companies, for fear of that, will be looking to automation, which then leads us back to the problem of structurally high unemployment, which means borrowing will continue to essentially pay people not to work. This is the kind of cycle that appears to be emerging, and certainly that is a philosophy that is wholly embraced by the Democratic Party.
Right. Okay. great summary, and thanks very much for that, Rick. And we'll see everybody next month on a new episode of the RITE Report.